Man wants to start investing, but terms like mutual fund, index fund, ETF, and hedge fund make his head spin. They all sound like different dishes on a confusing menu. Let's clear it up in plain language. No finance degree required. First, what is a fund? A fund is basically a big shared pot. Many people put their money together, and a professional or a simple system invests that pool into a wide mix of stocks, bonds, or other assets. Instead of trying to pick winning stocks yourself, you own a small slice of the entire collection. When the investments grow, everyone shares in the gains and losses. This teamwork gives you instant diversification and lets experts or rules handle the day-to-day decisions. Index funds, the buy-the-whole-market approach. An index fund is one of the simplest and smartest ideas in investing. It doesn't try to beat the market. It just copies a market index, such as the S&P 500. Picture a big race with hundreds of runners. Instead of betting on one person to win, you bet on the average performance of all of them. That's exactly what an index fund does. Because it follows a set list of companies automatically, there's very little buying and selling. This makes it passive. Result? Much lower fees, less taxes from trading, and often stronger long-term results than funds where managers try to outsmart everyone. Index funds are perfect for beginners who want to invest steadily, forget about daily market drama, and let time do the heavy lifting. They're a favorite choice for retirement accounts. ETFs, exchange-traded funds, the flexible version. ETFs are like index funds' more convenient cousin. They also hold a basket of stocks or other assets, giving you broad diversification. The big difference: ETFs trade on the stock exchange throughout the day, just like regular shares. You can buy or sell them at any time the market is open, and you see the exact price you're getting. Most ETFs are passive, tracking an index, so they keep fees very low. Some are actively managed, but the majority stay cheap and simple. They're also usually more tax efficient than traditional mutual funds because of how new shares are created and redeemed. ETFs are great if you like flexibility, want to start small, even with just one share, and still enjoy low costs and diversification. Mutual funds, the actively managed option. Mutual funds also pool money from many investors and buy a mix of assets. But here's the key difference. Most are actively managed. A professional fund manager picks stocks, sells them, and tries to beat the market. This sounds appealing. Someone smart is working hard for you. However, active management costs more. Annual fees are often 0.5% to 1.5% or higher, which can add up and reduce your returns over decades. You can't trade mutual funds instantly. All buy and sell orders happen once a day at the closing price, called NAV, net asset value. This structure encourages longer-term holding, which can be helpful. Mutual funds suit people who want professional guidance and don't mind paying extra for it. They're still well-regulated and offer good diversification. Hedge funds, the high-risk, exclusive club. Hedge funds are completely different. They're not for average investors. Usually, you need to be an accredited investor with high income or net worth. These funds use aggressive strategies: short selling, borrowing money, leverage, derivatives, betting on falling prices, and more. The goal is to make money whether the market goes up or down. Fees are steep, often 2 and 22% of assets every year plus 20% of any profits. They're lightly regulated, which allows big bets, but also big risks. Hedge funds are like high-performance sports cars, exciting for experienced drivers with money to lose, but dangerous for everyday investors. Most people are better off with simpler options. Quick comparison table. Fund type. Management style. Fees. Trading flexibility. Best for. Risk level. Index fund. Passive, tracks index. Very low. End of day. Long-term, hands-off investors. Market. ETF. Mostly passive. Low. Real-time during market hours. Flexible, cost-conscious investors. Market. Mutual fund. Usually active. Medium-high. End of day. People who want professional picks. Varies. Hedge fund. Very active and complex. Very high. Restricted. Wealthy, experienced risk takers. High. Which one should you choose? Want simple, cheap, and proven long-term growth? Index funds or ETFs are usually the winners for most people. Prefer someone actively trying to beat the market? Mutual funds might fit. Have serious money, experience, and high risk tolerance? Hedge funds could be an option, but most experts recommend sticking to the simpler choices. The real secret to investing isn't finding the perfect fund. It's choosing something that matches your goals, time horizon, and comfort with risk, then staying patient. Time in the market beats timing the market. Start small, keep learning, and focus on steady progress. That's how stickman and most successful investors eventually build real wealth.